When stepping into the world of Forex trading, one of the fundamental concepts you'll encounter is the term lot. But what exactly is a lot? And why is it so crucial for your trading success? In this article, we'll break down the meaning of lots, how they work, and their significance in Forex trading. Let's get started. In Forex trading, a lot refers to a standardized unit of measurement used to quantify the amount of a currency you are buying or selling. Think of it like an egg carton. When you buy eggs, you typically purchase a carton that holds a specific number of eggs. Similarly, in Forex, lots define the number of currency units involved in a transaction. There are several types of lots in Forex trading. Standard lot. This is the most common lot size, equivalent to 100,000 units of currency. Mini lot. A mini lot is 10,000 units of currency. Micro lot. A micro lot consists of 1,000 units of currency. Nano lot. A nano lot is the smallest size, representing 100 units of currency. Different brokers might display the quantity in lots or in actual currency units, so it's essential to understand how your broker presents this information. Trading in lots is essential because the Forex market operates on very small price movements known as pips. To see significant profits or losses from these tiny fluctuations in currency values, you need to trade substantial amounts. For instance, let's consider trading with a standard lot size of 100,000 units. Here's how it affects pip value. To illustrate how lot sizes affect pip values, let's look at some examples. USD JPY at an exchange rate of 119.80. Pip value 0.011980 x 100,000 8.34 USD per pip. USD CHF at an exchange rate of 1.4555. Pip value 0.0111.4555 x 100,000 6.87 USD per pip. When the US dollar is not the first quoted currency, the formula changes slightly. For example, Euro USD at an exchange rate of 1.1930, pip value or 0.111930 x 100,000 8.38 x 1.1930 10 USD per pip. GBP USD at an exchange rate of 1.8040, pip value are 0 or 11.8040 x 100,000 5.54 x 1.8040 10 USD per pip. Each broker may have different conventions for calculating pip values, but they will provide you with this information, ensuring you know the pip value for the currency you are trading. You might wonder how a small investor can trade such large amounts of currency. This is where leverage comes into play. Leverage allows traders to control larger positions with a smaller amount of capital. Think of your broker as a bank that lends you money to trade. For instance, if you want to trade a standard lot of 100,000 units, your broker might require you to deposit only a fraction of that amount as margin. For example, if your broker offers a leverage of 100.1, you would only need to deposit $1,000 to control a position worth $100,000. Here's how it works. Deposit, margin. You deposit $1,000. Leverage ratio. With a 100.1 leverage, you can control $100,000. Risk management. If your position incurs losses, those losses will be deducted from your account balance. The minimum margin requirement varies by broker. In our example, with a 100.1 leverage, the broker requires a 1% margin. This means for every $100,000 traded, you must have $1,000 as a deposit. If you decide to buy one standard lot, 100,000 of USD JPY, you would need to maintain at least $1,000 in your account to keep the trade open. If your account balance falls below this threshold due to losses, the broker will automatically close your trade to prevent further losses. Now that you understand how lots and leverage work, let's look at how to calculate your profit or loss from a trade. Suppose you decide to buy US dollars and sell Swiss francs. The quote is 1.4525, 1.4530. Since you are buying US dollars, you will use the ASK price of 1.4530 to open your trade. You buy one standard lot, 100,000 units, at 1.4530. A few hours later, the price moves to 1.4550. To close your trade, you must sell at the BAD price of 1.4550. To calculate the profit, the difference between 1.4530 and 1.4550 is 0.0020 or 20 pips. Pip value, chart 0.01145 x 100,000 6.87 USD per PP. Total profit 6.87 USD per pip x 20 pips, 137.40 USD. When entering or exiting a trade, you will encounter the bid-ask spread. This spread is the difference between the price at which you can buy, ASK, and the price at which you can sell, BED. You will use the ASK price to enter a trade. You will use the bid price to exit a trade. This spread is a cost associated with trading and can impact your overall profitability. Understanding what a lot is and how it functions in Forex trading is crucial for any trader. By grasping the concepts of lots, pip values, and leverage, you can make informed trading decisions that align with your financial goals. Whether you are a novice or an experienced trader, mastering these fundamentals will enhance your trading strategy and help you navigate the Forex market effectively. For more insights into Forex trading and to enhance your trading knowledge, connect with us at K9 Investments Trading. Remember, knowledge is power in the world of trading.